Basics of Investing. Chapter 12, Taxes and Regulation. Section 1, Capital Gains. A capital gain is the profit you make when you sell a capital asset for more than its adjusted cost basis. The key word is sell, because a gain usually becomes taxable when the sale happens, not just because the value went up on paper. Capital assets can include stocks, bonds, real estate, crypto, and even collectibles. So this idea shows up in many kinds of investing. At the simplest level, you start with sale proceeds and subtract your adjusted basis. If that number is positive, you have a gain. If it is negative, you have a loss. That basic formula sounds simple, but the word adjusted is doing a lot of work, and that is what makes accurate tax reporting important. Your cost basis usually begins with what you paid for the investment, but it does not always stay there. Certain purchase costs, such as commissions, can increase basis, while selling expenses may reduce the amount you effectively received from the sale. In real estate, capital improvements can also increase basis over time, which can reduce the taxable gain later. Suppose you bought an investment for $10,000 and paid a $100 commission, then sold it for $13,000 with $200 of selling costs. Your adjusted basis would be $10,100, your net proceeds would be $12,800, and your taxable gain would be $2,700. This is why good record keeping matters so much, because the wrong basis leads directly to the wrong gain or loss. An investment can increase in value without creating an immediate tax bill. If you bought a stock at $100 and it rises to $140, you have an unrealized gain as long as you still own it. Once you sell at that higher price, the gain becomes realized. In most taxable accounts, realization is the event that triggers tax treatment. This is why the timing of a sale matters for planning, especially near year-end. A portfolio can look more valuable on paper, but taxes usually enter the picture only when ownership changes through a sale. How long you hold an asset can change the tax rate applied to the gain. The holding period starts the day after you buy the asset and includes the day you sell it. If you held it for 1 year or less, the gain is generally short-term, which means it is taxed at ordinary income rates. If you held it for more than 1 year, the gain is generally long-term, and long-term gains often receive lower rates such as 0, 15, or 20%, depending on income. That difference can make the same investment result produce very different after-tax outcomes. In practice, investors sometimes focus on price movement and forget that the calendar matters too. A taxable capital gain generally appears when you sell a capital asset for more than its basis. That can involve individual stocks, bond funds, bonds, real estate, crypto, or collectibles. The important point is that the tax event is usually the sale itself, not simply the rise in market value. If an asset climbs in price but you continue to hold it, there is usually no taxable gain yet in a regular taxable account. Once the asset is sold, you compare what you received with your adjusted basis to determine the gain. So when investors ask whether they owe tax, the first question is often not how much it went up, but whether they actually sold it. Capital losses are valuable because they can reduce the taxes created by gains. Tax rules generally match short-term losses against short-term gains first, and long-term losses against long-term gains first. If losses remain after that first step, they can usually be used to offset the other type of gain. If you still end up with a net capital loss, up to $3,000 per year may reduce ordinary income, and any unused amount generally carries forward into future years. That means one bad investment year can still provide tax value later. Instead of looking at each sale by itself, it helps to look at the portfolio as a whole when thinking about taxes. Here is a straightforward example. Imagine you buy 100 shares at $50 each, so your basis is $5,000. 14 months later, you sell those shares at $75 each, so your sale proceeds are $7,500. The realized gain is $2,500. Because you held the shares for more than 1 year, the gain is long-term. If your applicable long-term capital gains rate is 15%, the tax on that gain would be $375, assuming no other adjustments. This kind of simple example shows the full chain from purchase to sale to tax bill. Losses can directly reduce the tax due on gains. Suppose you had that same $2,500 gain. but you also sold another investment at a $1,000 loss. After netting the two together, your net capital gain would be $1,500. If that net gain is taxed at a 15% long-term rate, the tax would be $225 instead of $375. The investment loss is still a loss economically, but it softens the tax impact of gains elsewhere in the portfolio. This is one reason investors often review gains and losses together before year-end. Share identification matters when you bought the same investment at different times and at different prices. For example, if you bought 100 shares at $20 and later bought another 100 shares at $35, those two lots do not have the same basis. If you sell 100 shares at $40, the tax result depends on which shares are treated as sold. With specific identification, you choose the lot, which can change both the gain amount and the holding period. Without that election, many brokers default to FIFO, meaning first in, first out. So, the same sale price can produce different tax outcomes depending on which shares are attached to the sale. FIFO can also create a mix of long-term and short-term gains in a single sale. Suppose you sell 100 shares at $55 each, for total proceeds of $5,500. Under FIFO, the oldest 50 shares bought at $30 are treated as sold first, producing a long-term gain of $1,250. The next 50 shares bought at $40 are sold next, producing a short-term gain of $750. That gives you a total gain of $2,000, but the tax is split because the long-term and short-term portions are taxed differently, at 15% on the long-term part and 24% on the short-term part. The total tax would be $367.50. This is a good reminder that one transaction on a statement can contain more than one tax character underneath. Several common mistakes cause capital gain reporting problems. One is treating a paper gain as taxable before an actual sale happens. Another is forgetting that basis and selling costs can change the amount of gain, so the taxable number is not always just purchase price versus sale price. Investors also make errors by applying one holding period to all shares, even when different lots were bought at different times. FIFO rules can be missed as well, especially when no specific identification was made. And finally, many people overestimate how much ordinary income a capital loss can offset, forgetting that the annual limit is generally $3,000 after gains are netted. If you keep those trouble spots in mind, the mechanics of capital gains become much easier to manage. Section 2. Tax types. Not all investment income is taxed the same way, and that difference can change your after-tax return. Two investors can each earn $1,000 and still owe different amounts of tax depending on the type of income, the holding period, and the kind of account involved. Interest, dividends, and capital gains can all follow different rules. A short-term gain may be taxed like ordinary income, while a long-term gain may receive a lower rate. The account matters too, because a taxable brokerage account, a traditional retirement account, and a Roth account do not handle taxes in the same way. So, when evaluating an investment result, before-tax performance is only part of the story. In investing, ordinary income means income taxed under the same rate structure used for wages and salaries. Interest is usually the clearest example, and non-qualified dividends and short-term capital gains often fall into this category as well. Because the tax system is progressive, different layers of income can be taxed at different rates. That means additional taxable investment income can be taxed at a higher marginal rate than earlier dollars were. For many beginners, the word ordinary sounds unimportant, but here it simply means regular income tax treatment. Understanding that category helps explain why some investment income can feel more heavily taxed than expected. Marginal rate and effective rate are related, but they are not the same thing. Your marginal rate is the tax rate that applies to your next dollar of taxable income. Your effective rate is your average rate across all taxable income after lower brackets have been applied to the earlier layers. So if someone says they are in the 22% bracket, that does not mean all of their income is taxed at 22%. It usually means only the top slice is taxed there. For investment decisions, the marginal rate often matters more, because it tells you the likely tax rate on additional interest, short-term gains, or other new taxable income. Keeping those two ideas separate prevents a lot of confusion. A capital gain is the profit from selling an asset for more than its cost, but for tax purposes, the holding period is crucial. If you sell after 1 year or less, the gain is generally short-term. If you sell after more than 1 year, the gain is generally long-term. That classification can lead to a meaningful difference in tax rates, even when the gain itself is identical. For example, buying at $1,000 and selling at $1,300 creates the same $300 gain either way, but the tax treatment may change depending on how long you held it. That is why investors often pay attention not just to price targets, but also to timing. Dividends and interest may both look like cash arriving in your account, but they are not automatically taxed the same way. Qualified dividends often receive lower tax rates if the required conditions are met, including holding period rules. Non-qualified dividends are generally taxed as ordinary income. Interest is also generally taxed as ordinary income and usually does not receive capital gains rates. So two investments with similar cash payouts can still produce different after-tax results. Before assuming all income distributions are equivalent, it is important to identify the exact source of the payment. Account type can change when taxes apply, even when the investment itself is identical. In a taxable account, dividends, interest, and realized gains may create taxes in the year they occur. In a traditional 401k or similar account, taxes are usually deferred until money is withdrawn. In a Roth IRA, qualified withdrawals may be tax-free. The underlying categories of income still exist, but the timing and practical effect of taxation can be very different. This is why asset location matters. Where you hold an investment can affect what you keep after taxes. Investors often focus on what to buy, but where to hold it can matter too. A simple way to classify investment income is to start by asking what kind of event happened. Was it interest, a dividend, or a sale of an asset? If it was a sale, then ask whether there was actually a gain. If there was a gain, the next question is how long the asset was held before the sale. That sequence helps you decide whether the amount belongs under ordinary income treatment or long-term capital gains treatment. In other words, classify first and rate second. Working in that order makes the tax rules feel much more organized. Maria's example shows how one person can have different tax treatment on different kinds of investment income in the same year. Her $1,200 of interest is taxed as ordinary income, so at a 22% rate, the tax is $264. Her $2,000 of qualified dividends is taxed at a 15% rate, creating $300 of tax. Her $1,500 short-term gain is also taxed as ordinary income, so at 22%, the tax is $330. Altogether, the tax on those investment items is $894. The important lesson is that the same investor does not automatically get one single tax rate for all investment income. Maria's tax bill would improve if the same gain had been realized after a longer holding period. If she sold after 10 months, the $1,500 gain is short-term and taxed at 22% for a tax of $330. If she waited until 14 months, the gain becomes long-term and is taxed at 15% for a tax of $225. The investment gain itself did not change, only the holding period did. That 4-month difference would reduce the tax by $105. This is a clear example of how time can affect after-tax returns without changing the underlying investment result. Many tax mistakes come from putting income into the wrong category. A common one is assuming all dividends are taxed alike, when qualified and non-qualified dividends can be treated differently. Another is mixing up marginal and effective tax rates and using the wrong one for planning. Investors also forget the 1-year holding period and misclassify gains as long-term or short-term. Account type is another frequent blind spot, because taxes in a taxable account do not work the same way as taxes in retirement accounts. A few basic questions about income type, holding period, and account location can prevent most beginner errors. Section 3. Regulations. Regulations matter because they shape how markets operate and how investors interact with them. They set rules for trading, account opening, disclosures, and reporting. So investing is not just a private transaction between buyer and seller. Regulations also aim to promote fairness and transparency by requiring information to be provided in consistent ways. Just as importantly, they help protect investors from fraud and abusive behavior. For individuals, this shows up in practical places like tax forms, identity checks, and record keeping requirements. In other words, regulation is part of the normal investing environment, not a separate topic off to the side. More than one regulator can affect a single investment decision. The SEC oversees securities markets and many of the rules around trading, disclosures, and broker-dealers. The IRS handles federal tax rules, which is why a stock sale can also become a tax reporting issue. State regulators may oversee some offerings or local enforcement matters, and investors outside the United States face similar oversight from agencies in their own countries. So, one simple action, like selling shares in a taxable brokerage account, may touch both market regulation and tax regulation at the same time. The product, the account type, and where the activity occurs all influence which rules apply. Most investors regularly encounter a few main categories of rules. Securities rules cover how investments are issued, sold, and traded, along with disclosure and market conduct requirements. Tax rules govern dividends, interest, gains, and losses, and determine how those items are reported. AML and KYC rules require identity verification and monitoring, which is why brokers ask for personal information when you open an account. Retirement rules add another layer by setting contribution limits, withdrawal rules, and required distributions for certain accounts. When you know which category you're dealing with, the rule itself usually makes more sense. These rules appear in everyday investing in very practical ways. Insider trading is prohibited, so people cannot legally trade on material non-public information. When opening an account, brokers often request identification and may ask follow-up questions because AML and KYC rules require them to verify who you are. At tax time, forms such as 1099-DIV, 1099-D-ENTS, and 1099-B report different kinds of activity to both you and the IRS. Retirement accounts bring their own timing rules around contributions and withdrawals. So regulation is not just about major scandals or courtroom cases. It influences routine steps investors take all year. Regulation changes over time because markets, products, and risks change over time. Major market events often lead lawmakers and agencies to tighten oversight or add new requirements. A well-known example is Dodd-Frank, which followed the 2008 financial crisis. More recently, digital assets have drawn growing attention, leading to more questions about tax treatment, reporting, and record keeping. As new products appear, the rules often evolve to catch up. For investors, that means compliance is not something you learn once and never revisit. It helps to think of compliance as an ongoing process rather than a single task at tax time. First, identify which rules apply based on your account type, investments, and activities. Then review disclosures, account documents, and notices so you understand fees, risks, and reporting obligations. Keep records as you go because those records become the foundation for tax reporting and responding to questions later. If you receive a notice from a broker or tax authority, responding quickly can keep a small issue from becoming a larger one. A steady process usually works better than trying to reconstruct everything at the end of the year. One stock sale can involve several layers of rules at once. Maria bought shares for $5,000 and later sold them for $8,000, so she has a $3,000 gain. Because she held the shares for more than a year, that gain is long-term for tax purposes. Her broker reports the sale on Form 1099-B, including key details such as proceeds and, in many cases, cost basis information. She then uses those records to prepare her tax return correctly. So even one ordinary sale can connect market rules, holding period rules, broker reporting, and tax reporting. A wash sale rule can change what looks like a straightforward tax loss. If Maria sold a stock at a loss and then bought substantially identical shares within 30 days before or after that sale, the loss would generally be disallowed for the moment. That means she cannot use that loss immediately to offset gains. Instead, the disallowed loss is added to the basis of the replacement shares. The tax effect is delayed rather than erased, because the higher basis may reduce a future gain or increase a future loss when those replacement shares are eventually sold. This is a good example of regulation changing both timing and record keeping. When compliance goes wrong, the consequences can range from minor inconvenience to serious legal trouble. A simple reporting error may trigger an IRS notice asking for clarification or correction. If the mistake changes the tax owed, extra tax, interest, and penalties may apply. More serious violations can lead to fines, and intentional misconduct such as fraud or insider trading can lead to criminal charges. Incomplete records often make even honest mistakes harder and more expensive to fix. That is why small errors deserve attention before they grow into bigger problems. Good compliance usually comes from a few consistent habits rather than expert-level tax knowledge. Keep organized records for more than just the current year, because basis questions and carry-forwards can stretch across time. Do not ignore small transactions, since small sales, dividends, or adjustments can still matter on a return. Pay attention to wash sale notations and other broker remarks that signal a special rule may apply. And when something is unclear, verify it with your broker or advisor instead of guessing. Those habits make both tax season and long-term record keeping much easier. Section 4. Compliance. Compliance in investing means following the rules connected to your accounts and transactions. That includes tax laws, reporting requirements, and market rules, not just one isolated set of regulations. The purpose is broader than avoiding trouble. Compliance supports fair markets, investor protection, and accurate tax reporting. Individual investors deal with it when they report gains, dividends, and interest, while professionals and firms face additional obligations. So compliance is really the practical side of regulation in everyday investing. It is the process of turning the rules into consistent action. Different participants have different compliance responsibilities. Individual investors usually focus on accurate reporting of gains, losses, dividends, interest, and other taxable activity. In some cases, they may also need extra filings for foreign accounts or foreign assets. Firms and financial professionals have a wider set of duties, including disclosures, client communications, operational controls, AML monitoring, suitability standards, and detailed record keeping. That means an investor's compliance burden is usually narrower, but still important. Knowing which responsibilities are yours helps you avoid both overconfidence and unnecessary confusion. Several regulators play central roles in investment compliance. The IRS focuses on tax reporting and tax compliance, which is why so many investment activities connect to forms and filing rules. The SEC oversees securities markets and federal securities laws, helping govern how securities are offered, traded, and disclosed. FINRA supervises many aspects of broker-dealer conduct and operations. Other countries have comparable agencies with similar functions, even if the names differ. Understanding who does what helps explain why the investing system involves multiple layers of oversight. Noncompliance can become costly faster than many investors expect. Missing a filing, overlooking a reporting rule, or failing to pay tax on time can lead to fines and penalties. If tax remains unpaid, interest may continue to accumulate. Sometimes the fix requires amended returns, additional forms, or a deeper review of past records. In more serious cases, there may be audits, account restrictions, or legal action. The earlier a problem is identified, the easier and cheaper it usually is to correct. A useful annual compliance routine is fairly straightforward. Start by identifying what rules apply to you based on your accounts, transactions, income, and any foreign holdings. Then gather the key documents, including statements, tax forms, and trade records. Use those records to complete the forms required for your situation, making sure income and sales are matched properly. After that, file on time, pay what is due, and keep copies of what you submitted. Doing this in the same sequence each year reduces stress and lowers the chance of missed items. A few forms appear often in investment reporting, and each one has a different role. Form 1099-B reports investment sales from brokers and serves as a starting point for gain and loss reporting. Form 8949 is where individual capital asset sales are often listed in detail. Schedule D then summarizes gains and losses, while Form 1040 is the main individual tax return that pulls income together. Depending on the situation, other filings may matter too, such as Form 1116 for a foreign tax credit or the FBAR for certain foreign financial accounts. The key is matching each activity to the right form instead of assuming everything belongs in one place. Good compliance depends on both records and timing. Investors should keep broker statements, trade confirmations, dividend records, interest records, and any documents tied to foreign accounts or foreign taxes. Those records support the numbers that eventually appear on a return or separate filing. Deadlines also matter because not every obligation follows the same calendar. Some foreign reporting requirements have their own due dates, and missing paperwork is a common reason people overlook them. As a general rule of thumb, retaining records for 3 to 7 years is often wise, though some basis records may need to be kept even longer. Maria's situation shows how one investor can trigger several reporting obligations at once. Her $5,000 stock gain is reported using broker records and then flows through the capital gains reporting process. She also received foreign dividends, which must be reported in US dollars, so currency conversion becomes part of compliance. If foreign tax was paid on those dividends, that may support a foreign tax credit using Form 1276. On top of that, if her London account exceeded $10,000 equivalent, an FBAR filing is required. One investor, 1 year, and several separate compliance steps can all exist together. Many compliance mistakes are simple but still costly. One common error is ignoring foreign accounts or foreign assets because they seem small or inactive. Another is mixing records across accounts, which makes it harder to track basis, income, and reporting responsibilities correctly. Investors also underreport small gains, assuming minor sales do not matter, even though brokers may still report them. Forgetting basis adjustments is another major problem, especially after reinvested dividends, splits, mergers, or similar events. Careful separation of accounts and complete records solve many of these issues before they start. Before filing, a short checklist can catch many preventable mistakes. Ask whether you sold any investments during the year, because even one sale can create reporting duties. Confirm whether you received dividends, interest, or any other investment income. Review whether you had foreign accounts or foreign source income, since those can trigger extra reporting. Then make sure your own records match the forms you received and that all deadlines are accounted for. A brief review like this often saves far more time than it takes. Section 5. Reporting. Investment reporting matters because it turns your investing activity into an official tax record. That record is what determines whether income, gains, losses, and adjustments are properly reflected for tax purposes. Good reporting does not just help you avoid penalties, it also helps prevent overpaying tax by making sure basis and other details are handled correctly. Some foreign holdings or accounts may require separate disclosures as well, so reporting can extend beyond ordinary tax forms. The quality of the final report depends heavily on the quality of the records behind it. In practice, careful reporting is where investing, taxation, and documentation all meet. Investment reporting covers more than just selling assets. Capital gains and losses from sales are one major category, but dividend income and interest income also need to be reported. Basis can change over time because of reinvested distributions, return of capital, splits, mergers, and other adjustments, so those changes matter too. Some investors also have foreign accounts or foreign assets that trigger separate disclosure requirements. The main idea is that many different investment events can create reporting obligations. Looking only at sales leaves out a large part of the picture. Broker forms are important, but they are starting points, not perfect substitutes for your own records. Form 1099-B reports security sales, 1099-D5 reports dividends, and 1099-N reports interest income. Those forms are extremely useful, but they may not always capture every basis detail or every adjustment correctly. Transferred shares, corporate actions, crypto transactions, and older holdings can create gaps. That is why investors need their own transaction history, confirmations, and supporting records. A good habit is to treat broker forms as evidence to verify, not as something to accept blindly. Cost basis often needs to be reconciled before you can report a correct gain or loss. The broker may show one number, while your own records reflect changes the broker did not fully capture. Stock splits, mergers, return of capital, reinvested dividends, and wash sale adjustments can all change basis. Transfers between brokers can create additional problems if basis information does not carry over cleanly. Since taxable gain or loss is based on sale proceeds minus adjusted basis, even a small basis error can change the tax result. Careful reconciliation protects both accuracy and credibility if questions ever arise later. The basis method used for a sale determines which shares are treated as sold, and that can materially change the gain or loss reported. FIFO often applies by default, meaning the oldest shares are treated as sold first. Specific identification lets you select the exact shares, but that choice must be properly made and documented. Average cost may apply in some mutual fund situations where shares are pooled into an average basis per share. The important point is not to choose the method that looks best after the fact, but to report the method that was actually in effect for that sale. Method affects math, and math affects tax. A wash sale changes basis by delaying the use of a loss, not by making the loss disappear forever. Imagine shares with a $5,000 basis are sold for $4,500, creating a $500 loss. If substantially identical shares are bought back within 30 days, the immediate deduction is generally disallowed. Instead, that $500 disallowed loss is added to the basis of the replacement shares. So if the replacement shares were purchased for $4,500, their new basis becomes $5,000. The loss is preserved, but its tax effect is pushed into the future until those replacement shares are eventually sold. Sales are generally reported in two stages. First, individual transactions are listed in detail, often on Form 8949, including dates acquired and sold, proceeds, basis, and any required adjustment codes. That level of detail separates short-term and long-term sales and shows how each transaction was treated. After that, the totals are carried to Schedule D, which summarizes the year's gains and losses. So the process moves from transaction-level detail to category totals. Understanding that flow makes tax reporting feel less mysterious and more like an organized checklist. Some reporting obligations sit outside ordinary capital gains reporting, and their deadlines matter just as much. The FBAR may apply to certain foreign financial accounts, and Form 8938 may be required for some foreign assets depending on the facts. Your annual tax return is usually due around April 15, but separate filings may have their own timing rules. An extension to file the return generally does not extend the time to pay tax owed. For some investors, estimated tax deadlines may also matter during the year. The big lesson is that one deadline does not cover every reporting obligation. The basis method can change the reported result even when the sale itself is exactly the same. Suppose you sell 150 shares of Growth Plus at $32 per share for proceeds of $4,800. Under FIFO, if the oldest 150 shares had a basis of $25 each, the total basis would be $3,750, and the gain would be $1,050. Under average cost, if the average basis were about $26.86 per share, the total basis would be about $4,028.55, leaving a gain of $720.71.45. Same shares sold, same proceeds, different reported gain. That is why the basis method must be identified before the Form 8949 entry is prepared. Most reporting mistakes come from incomplete records, wrong assumptions, or missed deadlines. One common error is assuming the 1099-B is always complete, even when basis details or adjustments may be missing. Another is using average cost when it is not allowed or not actually in effect for that holding. Investors also miss foreign account disclosures because they focus only on the tax return and forget separate reporting requirements. Late filing and late payment are another recurring problem, especially when people confuse an extension to file with an extension to pay. Add in mistakes around holding period or wash sale adjustments, and it becomes clear why careful review before filing is so valuable.